To develop a solid business plan that outlines your company's goals, strategies, and projected financials. To build a strong team with diverse skill sets and relevant industry experience. To identify and research potential investors who align with your company's mission and values. And to network and build relationships with industry leaders, mentors, and potential investors. To know all these, keep watching till the end on our today's topic, DOS for startups to get early stage funding. Before getting deep into today's video, this is Startup Charcha, where we provide amazing ideas, educating people with knowledge about startup and also with interesting news. So without any further delay, let's get into today's video. Your friends and family may or may not understand your idea well. They will primarily invest in you based on their belief in you and your abilities. Their investment amount and the expectation of return will usually be low. Nonetheless, they are your first set of believers and backers. Make sure to treat them the same as you would an external investor by taking the time and patience to explain your idea, the risks of investing in the business, the period they may need to stay invested for, and the possible returns. A little earnestness will go a long way. Angel investors, these are typically high net worth individuals, either first-generation entrepreneurs running family businesses over multiple generations, or working professionals employed at the highest corporate echelons. They stay ahead in their field and have good predictability and foresight about future trends. Their ability to understand your idea and its viability is much higher. Do research about the angels, their background, belief, and interest. Make sure your pitch is to the point. Investment is made in the founder than the idea at this stage, since the service or product has not seen a market fit yet. Make sure you have created strong ambassadors who will vouch for you and be supportive. Many synergies get identified by them for your business along with their other portfolio companies. It is a wealth management structure comprising second generation and beyond businesses that have accumulated generational wealth and are looking to invest strategically or financially. They can be similar to the angel investor in terms of their knowledge, background, and need for a strong reference. An important distinction from angel investors is that family office investing is not just more organized than angel investing, but also needs periodic updates and meeting of compliance. Institutional investors typically have a mandate from their limited partners, LPs, ranging from a specific sector focus to sector agnostic, and will evaluate your idea as per their mandate. Make sure to read about their mandate and check out their previous investments to understand their company selection criteria and investment style. It will save a lot of time and effort and prevent agony from applying to many investors and receiving a poor response from them. Presenting a good pitch to them is of utmost importance, preferably showing some traction. A tool that can be used to give an overarching theme and execution plan about your business is a business model canvas. Next is a unit economics analysis is necessary, with a quick projection of best case and worst case scenarios. Also, a good reference will make everything easier. Compliance, reporting, and organizational structure for an institutional investor are more sophisticated, with multiple team members, including deal sourcing, presenting the deal to the IC, documentation, and execution. Finally, incubators and accelerators. These are generally set up by universities or large corporates that want to promote startups in a particular sector and provide a launchpad for them. They onboard startups in cohorts after a careful filtration process and offer strategic advice, sometimes small starter capital, in the form of equity or grants, making the right connections, and prepping to pitch to institutional investors on a demo day, against a small advisory fee or advisory stake in the company on the success of a funding round. Such platforms serve as a good playing ground to try out different approaches for the business, getting direct advice from the incubator, accelerators managers, and peer startup founders from the cohort. Rarely are two startups from the same field or having the same business idea selected in a single cohort. Such programs polish and hone the fundraising skills of founders and often offer much needed mental and emotional support to early stage founders. Although, it is crucial to not apply to too many of them, thereby wasting precious time that could have been spent building the idea. While it may seem comforting to many to go through a curated program for launching their startup through these setups, do bear in mind that these programs require your time to attend meetings as a whole cohort as well as at an individual level. Do the prep work as is prescribed by the managers and present at different times, making the process time-consuming and demanding. Thanks for watching. If you liked this video, be sure to give it a thumbs up and subscribe for more. For more interesting